Hello everyone and welcome to this economic impact video. Today is August 11, 2022. As usual, I am with our chief economist, Stéfane Marion. Hello, Stéfane.
Hi, Martin.
Stéfane, it's never easy to do economic predictions, but we have to say that this time is particularly hard. There are a lot of many conflicting signs, and it's deep gray.
Yeah, and there's no summer vacation for the economy and financial markets, and we're seeing this again, and it brings volatility. We spoke to volatility last time, so not a big surprise. We're seeing a deceleration in the global economy, so it's a slowdown. It's a tangible slowdown. But Martin, the good news, as you can see on the slide, is that even though it's a slowdown, it's not yet a contraction. So it doesn't mean that some regions of the world are not experiencing a contraction, but for the global economy right now, still slower growth as opposed to recession.
And indeed, talking about conflicting signs, we've got Europe versus China, for example.
Yeah, and the complication when you look at these things, these regions, is that Europe is clearly about to enter recession. Their GDP was good, but the summer months are going to be more difficult, and that has to do with cyclical factors as well as the geopolitical backdrop is not conducive to strong growth in Europe, facing a significant supply shock on the energy front. So that region of the world is in contraction. However, there's a significant offset with China opening or partially reopening its economy. Given the size of the Chinese economy, it can be an offset to a European contraction. So what we've seen in recent months is that, recent weeks I should say, better growth from China. They had a dismal quarter in Q2, but the third quarter looks a little bit more solid.
Let's talk about the U.S., where this time the conflicting story is around the building up of inventories.
Yeah. People have claimed that the U.S. is in recession because they've experienced 2 consecutive quarters of negative GDP growth. That's too simplistic a definition. It's not the one being used by the NBER, which is the official agency that calls recessions, Martin. To confirm a recession, you need to see a significant drop in employment revenues, which means less jobs, right, historically. Mm-hmm. What we've seen in the U.S. is negative GDP, but it was accompanied by a deceleration in inventories at the corporate level because there's a lot of inventories out there, Martin. Corporations were scared about the supply chain, and the inventory level is at levels that we have not seen since 1984. So clearly, as you accumulate less inventories, therefore your GDP slowed down in Q2. So it was a technical movement in certain components of GDP that led to this contraction.
And this has all kind of repercussions on companies, earnings and inflation.
I kind of like GDP contracting when it's a move in inventories because that will mean potentially less inflationary pressures down the road. Let me explain, Martin. As inventories are stopped accumulating, supply delivery times are coming down, the backlog of orders coming down, and input prices are coming down. So it's actually good news given where we are in the cycle because we're all concerned about inflation, and we can see how the CPI relief surprised us in July, surprised markets with the inflation for goods, consumer goods, coming down from 12% at the start of the year to roughly 8% where we are right now. So it's a tangible deceleration.
So it is a deceleration, but it's still high, and therefore central banks still have to act.
Yeah, 8%, unfortunately, is still well above the 2% that the central banks are targeting. So we're seeing more monetary tightening. Expect more, Martin, in September. Now, the good news is that with the speed at which inflation is decelerating probably means that there's light at the end of the tunnel to stop the central banks later this fall, and that would be good news. Currently, the policy rate on both sides of the border stands at 2.5%, and you saw Canada, how aggressive they were. The Bank of Canada back in July, 100 basis points, a full percentage point increase in the overnight rate, something we had not seen since 1998. So they're moving aggressively. They'll move again in September, but perhaps with this inflation deceleration, they stop at 3 like we have in the forecast instead of going to 4%, which they advertised earlier this year.
Excellent. And actually markets, especially the bond market, is lowering expectations.
Yeah, starting to warm up to a scenario where they stop sooner rather than later. But Martin, again, we have to confirm that this deceleration endures for a few more months.
Lots of questions from our viewers on the real estate market, Stéfane. Worries about this important part of the economy. What's your take?
Yeah, well, the overnight rate has increased quite dramatically, and the mortgage rate is well above the overnight rate. The 5-year mortgage goes to, above 4% nowadays. So that's been a significant increase. And we've seen the impact on Canada, a significant deceleration in home sales, down below their decade average, coming down in every market. No one has been spared by a slowdown. Consumers are nervous about the outlook for interest rates. So until we stabilize interest rates, I think activity is going to be on the soft side. And from a Canadian perspective, the main uncertainty or the main concerns is that there's a lot of people that took variable rate mortgages in recent years, and they could be impacted quite significantly. And how big a supply shock? And will that lead to big home price declines because people can't afford homes or people are forced to sell their homes? Martin, our colleagues have made a very interesting analysis in recent days, and I think it's important to remind people that, yes, there are people that have taken variable rate mortgages. It's about 1/3 of the overall mortgage market, but 67% of the variable rate mortgages that fixed payment in Canada, which enables consumers to absorb a certain increase in interest rates. That's really important. This is not the US back in 2005, 2008. So I encourage you to have a look at this study. And it's not just the variable rate mortgage versus fixed mortgage that we have to look at. We also have to look at the number of people that actually have a mortgage, right, Martin? And it's 35% of Canadians that have a mortgage. A lot of people that are homeowners that don't have or very little or don't have mortgages in Canada. So we have to take that into account. It's different from the US back in 2005 or 2006, 2007. So when you combine the two factors, as we do in our special report, we come to the conclusion that the payment shock, there is one, Martin, but it's between 0.5 to 1% of disposable income. Yes, it's annoying. It's a tax on consumption. But however, if your labor markets continue to hold the line like they are right now, it's a lesser bad. You are able to absorb that. So we're going to get deceleration, continued deceleration, but a massive contraction like we saw in the US back then, unlikely.
So it gets very technical, but you mentioned it, Stéfane. There is a special report available on our website with much more details, also going into the demographics supporting the real estate sector in Canada. So please take a look if you want more details. But if we conclude, Stéfane, lots of uncertainties. There's still a supply shock. There's still Ukraine. There's still high inflation despite a deceleration. Markets did well recently, but we're not out of the woods yet, and we need to remain prudent.
Yeah, expect volatility to endure over the coming weeks. We have yet to see confirmed that the great news on inflation needs to be confirmed again in the coming months to stop the central banks. So the good news, Martin, is that the central banks are still normalizing monetary policy. What we want to avoid is for them to move into restrictive territory when it comes to monetary policy. And the only way to avoid this is we have to keep inflation on the downtrend that we've seen in recent weeks. It needs to be there with us later this fall. So we're going in the right direction. Now it's just a matter of keeping that trend going.
Excellent. So our main thesis is still not for a recession. But we have to watch inflation.
I think it's avoidable if you keep these central banks away from restrictive monetary territory.
Excellent. Thank you very much, Stéfane. Thank you for listening. We'll be back in a couple of weeks. Take care.